What's up, you guys? Today we're going to talk about the 5 tax deductions for small businesses that are often ignored. Many business owners may already know that repair and insurance costs, salaries and earnings, office supplies, mortgage interest and taxes, and depreciation on property are all items that can be deducted. However, there are a few small business tax deductions that are sometimes ignored and could be put to great use. Now, before we begin, please remember to hit the like button, subscribe to this channel for more great content, and leave a comment down below. Let me know that you subscribe. Your help is greatly appreciated. Thank you. Now, the first tax deduction that we're going to talk about today is the home office deduction. Do you run your company out of one of your rooms in your house where you deal with clients, patients, or customers? If you use a portion of your house exclusively for doing business, you could be allowed to use a home office deduction for your personal income taxes. However, utilizing that room as both a guest room and office, for example, is likely to disqualify you. Decide whether to utilize the IRS's simplified approach if you qualify, or to deduct real expenses, for instance repairs or painting in the area used specifically for business. Utilities, general repairs, rent, and insurance are all deductible indirect expenditures based on the amount of your house utilized for business. Lawn upkeep and other associated costs are generally not deductible. You can, however, calculate your deduction using the simplified method by multiplying the square footage of the total area in your home that is used for your business by $5, up to a maximum of 300 square feet. Now, the second tax deduction for small businesses that are often ignored include carryover losses. You may be able to roll over the deduction to a future year when costs are higher than your revenue produced in the home office. However, this only works if you use the actual expense method in calculating the deduction instead of the simplified method. The carryover amount from the previous year's tax return can be found on Form 8829 toward the bottom. If the business incurred an operating loss and was not profitable, you might be able to carry that loss back for 2 years for potential tax refund, or carry it forward for 20 years with no limit on the potential deductible amount to offset future taxable income. The latter method could benefit taxpayers that are in a lower tax bracket but expect to move up in a higher tax bracket later on. As with any accounting questions, you should consult with an accountant or tax lawyer near you. Now, the third tax deduction for small businesses that is often ignored includes expenses for starting the business. You may be eligible to deduct expenditures such as consultancy fees, transportation, advertising, staff training and compensation, travel, accounting and legal fees that you spent to start up your business. You can deduct organizational costs and qualifying startup costs of up to $5,000 each. When your total startup or organizational expenditures reach $50,000, then both deductions are phased out. The amount of starting expenditures that exceed $50,000 is then deducted from each $5,000 deductible. According to the IRS, if you exceed $55,000 in expenses, you won't be able to take a first-year deduction and will have to amortize all of your organizational and startup costs during the following 180 months of operation. Now, the fourth tax deduction for small businesses that are often ignored include your losses incurred with bad debts. If your business has money owed that it cannot collect, then it may be a deductible expense. A bad debt, according to the IRS, is one that was formed or acquired in your business or trade, or one that was directly tied to your trade or company, and that has since become partially or completely worthless. Loans to suppliers, workers, distributors, clients, as well as obligations owed by an insolvent partner are examples of poor business debts. They only become bad debts once you've attempted to collect on them for a fair amount of time and taken reasonable steps to collect the debt but were unable to do so. However, You may only be able to claim this deduction if the amount owing to you was included previously in your gross income. Now, the fifth and final tax deduction for small businesses that are often ignored include legal, tax, and educational expenses. The money paid to your business consultants, lawyers, and accountants that are ordinary and necessary expenses directly related to operating your business are deductible for the tax year in which payment was made. Other possible deductions may include license and regulatory fees, tax preparation fees spent during the previous year, and costs for training and education. However, if you use money to acquire business assets, this may not be deductible. To recap, the 5 tax deductions for small businesses that are often ignored include the following. First, home office deduction. Second, carryover losses. Third, expenses for starting the business. Fourth, your losses incurred with bad debts. And 5, legal, tax, and educational expenses. As always, you guys, thank you for tuning in today. Please don't forget to hit the subscribe button. And until next time, see you later.